Well, the cool thing so what you're talking about is commercial financing.
Exactly, yeah.
And commercial financing is interesting because it's kind of this funny thing where with residential, like while there's ways to be creative and do this or that, it's still like it's a box, right? Like you can either do X, Y, Z, or then you cannot.
And it's solely you focused.
Right.
They don't care how nice the house is. They don't care how good of a deal you're getting.
Doesn't matter.
They care about the borrower.
Whereas with commercial, it is more focused on the asset. They want to know that you're a solid sponsor, a good borrower, but it is a lot more about the asset, which makes sense because when you buy a house, you have to pay for it. When you buy a 20-unit apartment building, you can't be expected to pay for it. The building is meant to pay for itself and then some, and that's what a commercial bank analyzes.
Yeah.
But so it's harder to answer, like when someone says, what can I do in this residential scenario? Here's what you can, here's what you can't do.
Yeah.
With commercial, there aren't such strict goalposts, which is bad because it's hard to give like a definitive answer when someone's like, could I do this? Like, maybe.
Could be zero down, could be 35% down.
Let's get into it to figure it out. But that's also the good thing because you can get creative. You can get like on a case-by-case, like unique solution,
It's also why the due diligence is like 6 weeks.
As I was thinking in my head right
if
now,
you're lucky.
This is why you do long due diligence. Make sure you do your enviro, your inspections, your appraisals, all that before firming up on the deal.
Yeah. Yes.
I'm going to retract from all the things I've said in previous episodes of just saying firm up. But that makes sense.
And I think that's important for people to look forward to. We talked a lot about the pros of going to 6+ units because the cap rate it starts working in your favor and you can get creative with your end values. And obviously the end value and the takeout's a lot of what we talk about. You still need to be solid unto yourself and you often will have to have larger down payments.
Yeah.
But after that, they look at the building as a performing asset and are financing on its strength as much as they're financing on your strength.
Like you're the backer, so they need to know that you're financially capable, right? But unlike residential, they're not so worried about like, well, how much is your car payment? That's not crucial. But they want to know that you're, solid. But with the commercial side, the other thing too, to your point, yes, larger down payments, but they also allow vendor takebacks.
Yep.
Whereas with residential, like you can't get, no matter what people like to say, you cannot get a vendor takeback to buy a duplex, right?
You cannot get a vendor takeback to buy a duplex.
Okay. Right. You like
okay, fine.
So could you? Sorry, to clarify, do people do it? Sure, but like, should that be happening? No.
I know nothing.
Yeah.
Well, we'll talk about that. I think we should do a whole episode about commercial financing and vendor takebacks because I think it is incredibly important. I was talking about someone about this the other day, and she was asking about purchasing a property effectively commercially. And I was like, you're going to get into you're going to have a significant down payment. She's like, well, how can I get into it with less down payment? Like, in theory, a vendor take back, but the property you're looking at is currently residential. You're talking about converting it to commercial. Like, you're opening a bag of worms with this sort of thing.
Yeah.
But then also, but are you buying it for your own business? Because there are some situations where a business can buy a building for its own owner-occupied sole use and get in with zero down.
100%.
Yeah. We've done a few of those. Yeah.
Yeah. Doesn't work if you're a realtor. They don't care about us. But if you're like a white collar,
if you have like a shop or like a company that needs a proper building, like we did it for you could seriously we did it for a we did it for
way too visual that if like any of this stuff it comes back like Neal's like. Wink, wink. What are you doing?
Yeah. We did it last year. We did one for a barbershop during a pandemic when they were closed half the year. Yeah. With no money down.
No way.
Yeah.
No way.
It was super frustrating because I, as a property manager, went through it. So I'm like, okay, well, I need a place to store my materials, to have an office if someone wants to drop off checks, and to even like, it sounds ridiculous, but I've got like 8 extra fridges kicking around. Like I needed a shop for that. And I think they still were like.
To have Chandler's problems.
8 fridges. 8 fridges. I've got fridge addiction.
Yeah. Back to the VTB thing for a second.
Yes.
So what I mean by you can't do it is that when you get a mortgage from a traditional bank,
can't do it for residential.
If you just do, for a residential property, for a 2-unit property or something like that, if you go to like a Scotia Bank or TD, all those banks have a clause in their contract that says no secondary financing permitted. You can't have a second mortgage registered. Do people register second mortgages later? All the time, sure, but up front at time of purchase.
You can't be doing that.
Also, or do they do promissory notes?
I'm sure people do lots of stuff.
Yeah.
And you can't have a borrowed down payment. So if you're saying, like if the bank says, great, where's your down payment coming from for this little duplex? And you say the VTB, then they say, well, that's not acceptable. Sorry, for 2 reasons. You can't borrow your down payment. You can't have a second mortgage. But could you do a 2-unit commercially? Yes. And then it gets...
On a side note too, when you say you can't borrow your down payment, An unsecured borrowing.
Right, an unsecured borrowing.
Yeah. Okay.
That's right. So if you have a home equity line of credit, that's secured borrowing because that's really your money.
Yep.
It's your equity. You're just accessing it through a credit facility. That's different.
Secured means registered against an asset, whereas unsecured is like, here's a line of credit.
Or credit card.
Yeah.
That's right.
Just because we're sort of or previewing some future things, because I do think we need to do a full episode on vendor takebacks. But just for real lay terms for people not understanding, here's a hypothetical example. It's commercial financing and you need to put 25% down. There could be a scenario whereby you've only got 15% down payment, but the seller will hold an additional 10% mortgage that will be registered against the property. So
as a second mortgage.
Yeah. So you've got a 15% down payment. The bank is only willing to hold 75% loan. So the seller in second position to the bank loan will have another mortgage of 10%. We're going to delve into that in depth because it's incredibly interesting and it's very important and it's very useful for a lot of reasons, not just for the buyer, but also for the seller. Yeah. We'll talk about that in another episode, but just if people are curious, what are they talking about? It's called a vendor take back. That's kind of an old term for it.
Yeah. Those are great. I use those a lot to get rolling. Like I still do. People still do, honestly, even on like a very big scale. You'll see huge transactions taking place with vendor takebacks.
And sellers are down to them for a few reasons. Again, we'll talk about that in another.
Yeah.
When I was broke, I had rich habits.